My name is Jonathan Ford. I'm president and financial advisor at JFJ Advisory Services. I had been planning on starting a series of monthly market commentaries, and I figured that given recent events, this was a good time to start. So, we're going to talk about how this weekend's events may be impacting your portfolio and steps you can take um, following this. Some quick disclosures. Nothing is intended as a recommendation. This is informational purposes only. We are going to be discussing how I had positioned clients this past month. And so those investments may not be suitable for all investors and they may perform differently in different market conditions. All investing involves risk, and we cannot guarantee the outcome of any investment plan. Read our full disclosures at adviserinfo.sec.gov. Very quickly, just going to touch on what happened this weekend. U.S. and Israel launched a joint strike on Iran, and both Israel and Iranian news outlets are confirming that their supreme leader was killed in the strikes. Oil prices surged, and equity futures dropped about 1 to 1.5% across the board in pre-market trading. And then, so what will we actually discuss today? The meat and potatoes. Again, I'm going to tell clients how they have been positioned about this past month, so they know where they stand. And then we're going to talk about, how can you move forward and what can you do when, things are looking a little scary in the markets. I want to talk about how we manage retirement portfolios so you understand how the investments I'm going to discuss fit into the total portfolio. So, specifically within retirement accounts, I use a core and satellite approach. So, a majority of the assets are invested more passively. Broad, well diversified equity funds, broad bond funds, and we use a glide path that I designed, but it's very comparable to other glide paths where as you get closer to retirement, you allocate just a little bit more towards bonds. Fairly standard stuff in the core. We don't try to reinvent the wheel there. The satellite is where we can put a little spin on things and we can seek areas of interest, whether that be positioning more defensively, as we will talk about, or if there's certain sectors that have been heavily beaten down, I tend to be more of a contrarian when investing. I understand stocks get less risky as the price goes down, and so some of these heavily beaten down sectors could present actually opportunities for growth. So I did change client portfolios the last week in February, as we'll go in there. And again, this is mostly backwards looking, not meant as recommendations. Um, for market conditions can change pretty quickly. So what worked last weekend may not work next weekend. So this is a breakdown of specifically that 15% that I actively manage in retirement portfolios. We allocated a third to utilities, a third to Dow Jones. I'll touch on that a little bit, touch on all these, and then a sixth out to gold and a sixth to short-term treasuries. So the Dow Jones allocation, just real briefly, that's me not wanting to allocate all 15% of the portfolio into specific investment theses. This is me just pushing more of the portfolio back to market weight. So for the past month, about 90% of their of retirement assets had been invested in these broad indexes, and then only about 10% were pursuing more active strategies. And so, obviously, utilities, gold, and short term treasuries. Well, obvious if you're an investment nerd like me. For the uninitiated, those are a little bit more defensive. They aren't as cyclical. Um, they don't depend on the economy doing well. There has been some growing concerns, and so I had been positioning clients more defensively this past month. I'm going to jump ahead 2 slides real quick to show the performance. Um, Just to talk about utilities, most of this growth that is here in blue came from utilities. Utilities went up 9% approximately in the time that we held it. So that accounts for a large percent of the almost 4% growth the satellite portfolio had this last month. And 10% in a month, I'm always going to take that to the bank. I'm always going to be happy with that. And so I sold out of the utilities position. So what did I buy when I sold out of utilities? So as of Monday last week, I sold out of utilities and I added JEPI and financials. So what I was looking for when I moved out of utilities is I still wanted to be a little bit more defensive, and I didn't want to put it all into short-term treasuries or any treasuries for that matter. A lot of my clientele is very young, and so I prefer keeping them invested in equities as much as possible. So I used JEPI to get a little more equity exposure while still having some of that protection. If you don't know, JEPI is a covered call ETF. It owns stocks and it sells a call option against those. Um, if you're unfamiliar with options, that caps potential upside growth. So the stocks can only appreciate up to a certain point, but you collect cash each month from selling the option. So it helps hedge against a downward move. A really quick primer on that. And then again, I was looking through different sectors and different investment options I had available, and the financial stocks as well as technology stocks had been pretty beaten down this year. Tech stocks had been sold off largely due to a lot of concerns about AI and whether or not we're in a bubble. And so I also some of those concerns creep up from time to time, and a lot of things that I'm looking at and considering. And so I made a small allocation to financials because again it had been beaten down pretty heavily. I don't have a chart available, but it was getting near a recent low. So it was getting near what looked like it could potentially be a support level. And so I went with financials as a kind of contrarian trade. Again, being defensive this last month paid off pretty well. And again, markets haven't opened yet, but based on futures trading, that it's going to be pretty nice this morning. So that's what we have done. I'm going to break this down into 2 types of investors: the people still building their wealth, the accumulation phase, and people in retirement who are in the decumulation phase. So if you're still building your wealth, you technically have three options, but generally we don't recommend the last one. So you can stay the course. So if you're investing $100 each month doing that, you'll dollar cost average in if you have 10, 20, 30 years till retirement. You're going to see probably another few geopolitical events between now and then. Um, the way it is, and everyone who's come before you has seen similar risks. If you stay disciplined, then you're gonna be able to most likely reach your goals at some point. There's always gonna be noise and signals and ups and downs in the market, but over the long run, it tends to perform pretty well. Second option, um, back the truck up, buy the dip, as they say. These pullbacks can create opportunities. Buy low, sell high. The problem is it's sometimes scary to buy during the low. Um, the classic Warren Buffett quote: "Be fearful when others are greedy, and be greedy when others are fearful." But again, since coming to this last point is just um, whether you just keep on keeping on or you pour gas on this. Don't panic sell. Don't get too emotional in the decision making. Again, if you're in the accumulation phase, now if you're in the decumulation phase, I'm still not going to recommend panic selling, but I'll talk about that here in a second. But just we've seen geopolitical risks before, and unless you're heavily convinced that this time is substantially different than any other time, I would not recommend panic selling. All right, if you are in the decumulation phase, um, and you're making distributions from the account to pay your bills, you're already selling assets. Um, what you might want to look for is which assets do you want to sell. So if bonds are climbing as people seek safe investments and equities are falling, you can sell the bond portion of your portfolio to make your distributions, or sell more of the bond portfolio just to give. It accomplishes two goals actually. One is, as I have listed here, it gives the stocks time to rebound, but it also helps actually rebalance because as equities underperform and maybe bonds overperform, their portfolio will get a little bit out of balance. And so by just trimming down some of the bond position, you can actually get it back in the target allocation. And again, kind of just stay the course, is get back on track. Thank you for watching this, and book some time to chat at JFJ Advisory Services.com. And you can shoot us an email. You can find us on most major social media platforms at JFJ Advisory Services. And thank you again for watching.